everybody, welcome. I'm really excited to see everybody. I think what we thought about doing is starting, maybe Josh and Dean give a quick overview of what their companies do, so we can give you some context for our conversation about capital raising today. Josh, you go first?
Sure. Thank you very much. I'm very happy to be here and to see everybody. My name is Josh Riezman. I'm the head of U.S. Legal and Chief Strategy Officer for the U.S. for GSR. We're a global crypto market maker and trading firm. And really what we do is specialize in providing liquidity and risk management strategies for token projects and global investors.
Yes.
Thank you. Thank you for making it. I know we have a lot of tough competition between lunch and also Senator Tim Scott. So we're very flattered to share the group with you. I'm Dean Sovolos. I'm the Chief Legal Officer for B2C2. We're a global crypto liquidity provider. We are operating out of 6 market centers, headquartered in London, have an office in New York and the Jersey City area, Paris, Luxembourg, Japan. So the perspective that I'm going to bring to this panel is both as a practitioner, but also as an American who is looking to reinforce the role of capital markets and digital assets in everything that we're doing as a company.
And Troy, I think you should just introduce yourself because you are amazing in everyone, so you can leave your advice for 1,000 years.
Well, thank you. So Troy Paredes, I have my own consulting advisory firm and practice, but perhaps the most interest here is at one point in my career previously, I was a commissioner at the Securities and Exchange Commission. So very much kind of thinking through what it would be like if I were still in my former role as the SEC tries to navigate all the, quite frankly, opportunity, in some respects challenges, but the opportunities that lie ahead of them.
Great. Well, thank you. Okay, so we're going to talk, why don't you kick off with kind of what's been going on and how things are changing, because things are changing really, really fast. So why don't you guys talk through how we've seen projects raising capital under the current regulatory regime, and so things are changing, but we have still a lot of work to do.
So maybe I'll jump in and set the scene a little bit on kind of where we are. I think the history of raising capital in crypto has kind of evolved over time. From obviously from the Ethereum ICO to where we are today, we've seen a move away from ICOs due, importantly, to regulatory scrutiny on the way ICOs were being conducted in the 2018-2019 period, and move towards more of kind of a venture airdrop model where projects will raise typically venture rounds under various securities exemptions and look to airdrop their token to users and community members. And it's a big change in the distribution of how tokens reach market. And I would say now we're at a real turning point. In fact, we're starting to see a move back from projects for reasons I think we will touch on a little bit on this panel, is because of how the market structures evolved, because of the change of the regulatory environment. How can we reintegrate these offerings to users and community members earlier in the process and not rely strictly on venture funding? And we'll talk a little bit about that today, but there is, I think, a switch happening along at the same time that we discuss what is going to be the regulatory situation, both from the SEC and then legislative developments that will address this as well.
Dean, what are you saying?
What am I saying? From different vantage points. So in the boardroom, both as a chief legal officer and also as an executive for this global company, I'm heartened to see a lot of good signals coming out of the administration, coming out of the SEC, all positive developments, a lot of enthusiasm. Our client base is almost exclusively institutional investors, and I see a lot of enthusiasm there. Now, so 2 parts. Signals, great. Signals received by institutional investors, great, and they're acting accordingly as we enter the end of March. My concern is that we now have to move beyond signals, and that is something that I would also advise the board to consider about our U.S. operations. So, great that we have David Sachs, great that we have Paul Atkins, who's about to get nominated and confirmed, and great that we have the broader agenda of pushing innovation in the U.S. But what are the bills that are going to be moving through Congress in the next few months? Market structure bill, stablecoin legislation, those all need to start getting additional traction. What is the SEC going to do to clarify their jurisdiction and their enforcement and give us comfort as a company that this is what we should expect? And then by extension, within the market globally, other investors and will draw capital into the U.S. capital markets, which again, should be repeated. We are the center of capital markets, and we need to maintain that. On this same conversation, new topic, digital assets, and the way we reinforce that is by doing those things. And then finally, the National Bitcoin Reserve. Great that we're at the executive order stage. Very enthusiastic reception globally and especially in the U.S. But what are we going to do this year under Senator Lomas's leadership? Will we advance that? Will that be galvanized into the ecosystem and the structure that we're dealing with as a global company? I'm hopeful, but we want to start seeing tangible results going into the summer.
And I think I'd just add one more point, since we're both from liquidity providers on the stage of global liquidity that we see is at some time that I think people don't quite see that the vast majority of volumes in crypto are still ex-US and offshore. And so as we think through these developments, both on the regulatory and legislative side, one of the main things we're looking at is how do we create a structure for innovation that draws that liquidity to the US as the center for global capital that we saw in other markets like derivatives at the CME. And I think that's a main question for us is what is the process and what is the incentive by which we're going to move that liquidity back to the United States?
Well, speaking of that, and first, if people in the back want to sit, there's tables over here with empty seats. If you guys want to come sit down, there's plenty of seats at the tables here. So one of the things the Digital Chamber's been working on since December is a series of SEC policy priorities. And if you all haven't seen them, they're on our website, and I really recommend taking a look. We shared them with the SEC back in December before the administration changed, and then we also met with the Crypto Task Force on February 3rd. And we walked through them kind of line by line. And we're seeing the SEC move faster than I thought was possible. You guys spoke about the fact that, a lot of things changed very significantly, obviously, around capital raising for projects after 2018, 2019 with the ICO, enforcement actions, a lot of actions against crypto exchanges, crypto participants. We're seeing those actions dismissed, put on hold, formal investigations ended with actual formal notifications. Troy, you and I both spent time at the SEC. I was not at your level. I was on the staff. But have you ever seen anything like this? Like, did you expect to see things shift this quickly within 60 days? Yeah. My head's still spinning. I get giddy. I mean, if anybody's on the Chamber's Telegram chat, I rate things like that. I'm feeling giddy today, like all the time. But did you expect action this quickly?
So let me take those two.
Which, the part that I'm giddy or the part that, yeah.
Let me disentangle the two parts just to be clear. Have I seen anything like this in terms of walking back enforcement matters, what have you? I haven't. But I'm not sure I've seen anything like this, if you just big picture. So in that respect, I haven't, but I'm not sure there would be the same opportunity in the past, or that there had been the same opportunity in the past to expect this kind of change. But in terms of am I surprised or did I expect it? I'm not surprised. And one of the reasons I'm not surprised, if you think about what the critique was when it comes to the stance that the SEC took, the majority of the SEC took over the last few years, and the enforcement front, the response, and of course generalizing here, was that the SEC was engaging in so-called regulation by enforcement. Now we could have a very long, interesting conversation about what enforcement versus regulation by enforcement.
Yeah.
It's almost metaphysical. It's also very practical. So I'm going to kind of set on that to one side in the interest of the time that we have. But given that there was concern that the SEC was essentially regulating through its enforcement actions, it's not particularly surprising if you play that logic backwards, that to the extent there are open enforcement actions, the new majority at the commission, who had concerns about the commission's prior approach, would have tried to take steps to walk back the prior approach. And that's exactly, I think, what we've been seeing over the last couple of months. So from that perspective, given the critique, I'm not surprised by the actions that have been taken. I'd also note, and I've not gone back to map this or verify this, so this is our hunch, maybe informed hunch. I'm not aware of, or I'm not recalling, if you will, any of the enforcement actions that have been reported as having been dropped involving fraud.
No fraud.
Right. So there is this important distinction between what sometimes folks talk about a more regulatory technical violation as compared to fraud.
Correct.
And it's on the regulatory technical violation stuff where the regulation by enforcement fatigue has been most pronounced as compared to fraud. Now, that having been said, just to make one additional point in response to some of what's already been said, the going from policy to practice is a very, very big deal. I mean, we know the policy direction, and I think that's a shared policy direction across government when it comes to the topics we're talking about today. But you got to go from that policy choice to actually operationalize it, whether it's through legislation, and legislation usually has a regulatory component to it. So even if you're in the regulation path, there tends to be regulation at some point along that path, let alone when it comes to the regulation path as such, that's squarely before the SEC and the CFTC and otherwise. That's a big challenge. If you go to what the task force is doing at the SEC, that's all in furtherance of trying to figure out the regulatory regime, which has two basic fundamental challenges, I think, and therein lie the opportunities for the SEC. Just to mention them at a very, very high level, the first is the what is it question. What's the reach of the SEC's jurisdiction? And on that, so much focus is on what's the security for good reason. But there are other key jurisdictional questions too. Issuer, what's an offering, what's an exchange, broker-dealer, what have you. So there's the is it within the scope of our jurisdiction question. And then there is the to the extent it is within the scope of our jurisdiction, how in fact are we going to regulate it question.
Yeah.
And that's a really, really important one as well. In some sense, you can't get to the second one till you resolve the first, at least completely. But both of those pieces really do need to be worked out by the commission.
Yeah, look, I think operationalize is a key word and the key thesis for what the next steps are. We talk about that in the corporate context. We come up with strategy, we come up with ideas. How do we operationalize this? In terms of other impediments that we see, again, I'm bringing two perspectives. As an American, like we all are, and then separately as a practitioner, there are some, as a practitioner and as a lawyer, there are some structural elements that we see both within BTC2, but also with our clients on how are we dealing with custodial solutions, how are clearing firms evolving in this new asset class, what are the legal frameworks that we're going to be using, and even down to the agreements that we're using, right? We work very closely with ISDA for the past few years in the derivatives space, but beyond that, there's bankruptcy implications that become much more complicated when you're dealing with a cross-border arrangement. How do we not have to shoehorn those arrangements within digital assets into the traditional structure, and how does that structure evolve to accommodate digital assets? Those are a little more granular, but those are also impediments that we need to think about.
Just anything you add on that front? I think what's been very interesting on the enforcement cases that have been dropped and on the investigations that have been formally terminated. To your point, none of them were fraud-based, and that's what we were advocating, like a reset on enforcement actions that were not fraud-based. Obviously, we're not going to advocate for investor fraud cases to be dropped. But all those cases were brought on the theory that what was trading on these exchanges were securities, and that those exchanges needed to be registered as broker-dealers and national securities exchanges, or ATS, of combat. We're still strongly advocating for clear distinctions between what are securities and what are non-security digital assets, buckets of things that need to be carved out completely from the SEC, things that need to be designated as commodities, and things that are neither. So we've already seen the SEC come out with a statement that meme coins aren't securities. They're obviously not commodities, right? We're working on NFTs and a list of other things. But, Josh and Dean, what do you think is going to be the outcome of the past 60 days? I've worked with projects. We've talked about this a little bit with the movement towards venture around projects and seed rounds and Series A. It's been, in my experience, like to know what you guys are saying. A lot of projects move completely outside the U.S., Regis only, venture for the most part, SAFs only. They're not dropping tokens at early stage. Do you think that these kinds of changes, as we get farther down the road, right, we need more clarity, right? We need real clarity. What do you think the import's going to be of this type of movement for the kind of capital raising that you guys are looking at?
That's a great question. you know, one of the things we do is work with early stage token projects that are looking to come to market, and we help provide advisory advice to our position across exchanges. And, make no mistake, over the last 60 days, there's been a dramatic shift, and my most dramatic shift since I've been at Eastern, where for sure projects are looking to come back to Eastern in that sense. They want to investigate ways to raise money. They want to investigate ways to locate both their foundation and their DAO, and they want to re-engage in what is the largest market in the world. And the only thing stopping them is this word that I'm sure everyone else is tired of saying is clarity, is what does a compliant token offering look like? Both from the capital raise side to the listing side to the liquidity side. There's a lot of tax complications around where you set up your foundation and your DAO. And how do we piece those all together and make it positive for innovation? And, I think there's a lot to navigate as we move forward, but I think keeping the guiding light is important, but the demand is there. And we're already seeing projects engage both with us, but directly with the SEC, with their legislative representatives to kind of plead their case and say, hey, we want to do the right thing. Exactly how should we do it? Because we want to be here, but we obviously don't want to risk getting in trouble. And so it's been a big question. We're really excited.
So the question is, are these projects going to return to the U.S.? What am I seeing that I think is projectable out to other boardrooms of global companies and of U.S. companies? So I think the short answer is yes. I think that we're on the right path. You're going to see capital. You're going to see projects returning to the U.S. But there are, I think, three caveats. One is, I want to repeat what I said in the first answer. We have to move beyond signals. The SEC has to come out with clear guidelines. People like myself, as a chief legal officer talking to a board, need to give comfort that we're not going to be subject to arbitrary enforcement. That's even more of a pointed concern for people that are looking to bring capital and projects into the U.S. The second point, and Troy made a really nice distinction on this, that is a caveat here, is that we have to avoid a regulatory backlash. During the ICO days, there was a lot of capital, there was a lot of activity, but there's also a lot of fraud. And without the proper protections, without the proper avoidance of the pump and dump schemes, you're going to see a pushback in the U.S., and I think it's going to be a short-term solution that we have in place. So we need clarity, and that's a key word, but so are safeguards. And then finally, I point out as an executive of a global company, is that the U.S. is not the only jurisdiction that's competing for this capital, for these projects. There's a lot of great work being done globally. We have MiCA in the EU, we have the UK with the FCA, we have Singapore making a play really since 2020 in providing clarity, but also making themselves take on the identity of a world center of crypto capital. So we have to compete and beat that in order to have these projects return to the U.S. like the ICO days.
True, what do you think?
So I think that oftentimes talking about securities regulation or regulation more generally, whether it's financial or non-financial, but focusing on the SEC for this kind, there's often this framing of we can either protect investors or we can facilitate, promote capital formation, liquidity, what have you. And I suppose there's always a point at which, when anything push comes to shove and you need to make choices, that's the essence of trade-offs. That's the essence of policymaking and regulating and legislating and running a business and what have you. But I think there's a whole wide space where those objectives work consistently, are very much consonant, and one reinforces the other. It goes to the point that, yes, one doesn't want undue regulation that stifles creativity, stifles market participation, where folks don't genuinely know how to comply, even when they are genuinely trying to comply. That's a real difficulty. It's a practical matter. At the same time, there needs to be enough so that others are comfortable participating in those markets. This is just the essence of markets. And so striking that balance and not thinking about either we can be protecting investors or we can be facilitating innovation and market participation and liquidity and capital formation, but think about the ways in which you can actually do both simultaneously. I think that's important just as a starting point. Again, you reach points where you have to make choices, but there's a whole lot along the way where you don't have to make the tough choices. You can get a lot of, win-wins out of it. So that's point number one. Point number two is going back to the theme of Annemarie, your prior question, have I seen this before? I'm going to use a different this now on the question. What I haven't seen before is a circumstance where the intersection of regulatory details need to work with technological details. Right. And so as I've thought about how one tries to figure out what to do, you start with policy, and you can think about rules and regulations and legislation, but really quickly you get to the actual implementation. And then when you start thinking about, if you're thinking about, for example, custody, which gets a lot of attention, well, so think about how you're going to craft a rule that is workable in the context of underlying blockchain technology that meets the objectives that custody established for traditional broker-dealer activities was designed to meet, which is to simply say, make sure the assets are there, which seems like a pretty legit goal. You want to make sure the assets are there. It comes back to the integrity of the marketplace. How do you craft a rule without thinking through in a very technical way the underlying technology? And so there's this interesting, I think, unique intersection of you got to have the regulatory, as I often put it, the regulatory particularities, the technicalities of regulation that work with the technicalities of technology. That's a different challenge for regulators.
Yeah.
And yet I think without that, it can make it very difficult to figure out what the rules ought to be, because they got to work with the technology, and the technology allows for maybe new solutions that don't exist when you aren't able to leverage the underlying blockchain technology.
It's a very different problem the agency has right now. I'm glad that the Crypto Task Force was formed, and we're about to start working through answering all of the questions that Hester and the task force put out. So if anybody's a member of the Digital Chamber that's here today, we're launching those work streams next week, and I encourage everybody to sign up and help us work through those answers. For a long time now, we've been focused on how other regulators around the world are handling regulation around digital assets, capital raising, and looking at them in a way that's saying they're doing a better job. And I think maybe the SEC now has a chance to catch up and help us put capital raising in the U.S., as we were talking about earlier, back on the forefront, because we've always been the preeminent capital market, place in the world, I think. So what are we seeing, and who's doing a better job, and can we catch up?
It's really interesting. So, there hasn't been a lot of credit given to the Europeans recently, but I think this is one area where we can give them some credit. Look, they were pretty quick in their standards of rolling out MiCA, which is basically MiFID for crypto. And it did set a framework. Whether it's a perfect framework remains to be seen, and they can iterate on it. But it says a framework where if you build to this, these requirements, you're going to be pretty clear. And one of the most interesting aspects from our perspective that is kind of, I think less publicized from the MiCA perspective is effectively you can do an ICO on the regulated MiCA exchanges, right? You can bring your token to market, raise capital via the regulated exchange, because they view crypto effectively as non-security, non-commodity. It's its own thing. It has its own regulatory structure. And so, when we look forward to what that compares to in the US, we're very unlikely to get our own structure for crypto for all sorts of reasons. And so we're kind of playing with one hand tied behind our back. And so it makes all these conversations a little bit more ethereal and argumentative, in that we got to work through the complex distinction between the CFTC and SEC, and the way they just don't have to do it now in Europe, and they definitely don't have to do in other jurisdictions as well.
I'll also concur and compliment our European colleagues. They've gotten regulations, they've gotten policies, they've gotten some legal frameworks right or going in the right direction. Now, MiCA is solved for the fragmented markets. That's a big issue. Cross-border investment has been fostered. That's something we want to emulate. So we have clarity, safeguards as goals, and then also dealing with fragmented markets. The inconsistent compliance costs, which as a practitioner we would see in Europe, those are also working towards being solved. which is going to help liquidity across global markets. In the UK, where our company is headquartered, there's a bit of a divergence under the FCA. They've done a great job of safeguarding investor protections, and they have been, on the other hand, slow to adopt to some emerging trends. That's a cautionary tale from our European counterparts that we should not be deterring investment, particularly when you think about the ecosystem and the smaller shops that may not have the scalability in their compliance schemes to conform with the stringent regulations coming out of the FCA. So it's expensive, it's resource intensive, and it also deters some participants in the industry. So again, overall good in Europe, but there are lessons learned that we should take note of.
Yeah. Well, one of the things we have a couple of minutes, but I think it's really interesting to see now whether some of the non-U.S. exchanges start to let U.S. Citizens start to participate on their exchanges. Some of the most liquid crypto exchanges in the world are non-U.S. Do they start allowing U.S. residents to participate on the exchanges? Anybody have any thoughts? Troy, what do you think? If you were operating outside the U.S., would you start letting U.S. residents participate, go through AML and KYC and open wallets on your exchanges, or do you keep them out?
I think it's a business decision.
Yeah.
Right. I think it's a business decision informed by what the jurisdiction may be that you're subjecting yourself to, the regulatory jurisdiction you are or may be subjecting yourself to. And I would add, if you don't want to subject whoever you are, you don't want to subject yourself. One doesn't want to subject himself to a particular jurisdiction's regulation. It's important to do things to make sure that you don't find yourself accidentally doing that. So I think it's a business decision, but in part informed by jurisdictional range.
Yeah, and I think, look, what we're starting to see is a regionalization of this business, like you see in the securities business, like you see in the commodities business. But the problem is crypto is inherently global in funding. Yeah. And it's our really only global asset. And, the thing we say is the more you regionalize and put up these walled gardens, you do bifurcate liquidity. And what we really want to optimize for is maximize liquidity. Now, very different than a security. A token for a nascent project, liquidity is really like the oxygen for that network to hit in a way that it's not for an Apple stock, right, of Apple. And so the more walled gardens we create to bifurcate that liquidity, I think the worse it is for your average innovator looking to kickstart a decentralized network. And so we need to find a way to have interoperability, even as we regionalize and respect the regulations at local jurisdictions.
All right. We had 1 second. I'm getting the hook.
Again, as an American and as a practitioner, we execute value for the investing public by providing the liquidity. And that's why that's an important topic that we've talked about today.
All right. Well, thanks, everybody. That was great. Thanks to everybody in the audience. We really appreciate it.
Thanks, everybody. It was fun.